Ted basically said, look, my job is just to not swing until the ball is in one of my sweet spots, right? And that makes a lot of sense. Now, Warren Buffett said that Ted Williams's problem is that he only had so many strikes, right? So in other words, he couldn't control the pitches that the pitcher was pitching to him. So of the balls that were in the strike zone, they all might not be in his preferred area, but if it's going to be a strike, he's got to swing, right? So Ted Williams had to swing at a bunch of pitches that weren't his absolute perfect pitch. Warren Buffett has said, as an investor, I'm like Ted Williams, except I have an infinite number of opportunities. I can sit on my hands for years if I need to. I'm only going to swing when it's right in my absolute sweetest spot. So, Mike, you're basically saying this is not a time right now where the market's delivering you lots of fat pitches. So just wait. There's no pressure to have to make swings now.
I think so.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you back here for another monthly check-in with the team here at New Harbor Financial. We started doing this a few months ago and reaction's been very positive, so we're continuing to do it. New Harbor obviously is one of the endorsed financial advisors by Thoughtful Money. They're here with me on this channel every week, oftentimes after one of the big interviews that we do this week, where they bring us up to date on what the market's done recently. But every once in a while, we like to do these monthly deep dives to get a sense for what's burning most brightly on their radars. And today will be no exception. So I'm joined as usual by lead partners John Lodra and Mike Preston. Boys, good to see you guys.
Hey, Adam, good to see you.
Hello, Adam. Great to be with you again. Thanks for having us.
All right, guys. Well, look, awful lot to talk about since the last time you guys were on. Let's see here. Stock market, since the last monthly update of yours, stocks have rebounded quite dramatically. We have pretty much erased, I think we've officially erased all the losses that were, around the tariff concerns and Liberation Day and all that. So where do you see us now, guys? I guess the big question I've been asking everybody recently, I'll just ask you. Was the March-April drop just a correction in an otherwise intact bull trend, or is May more of a bear market rally, right? That's sucking people back in, getting them to feel really optimistic again, only to break their hearts.
Maybe I'll start answering that, Adam, and while I'm talking, I'm going to bring up a chart to talk to that. Right now, it looks like it was just a blip, honestly, but I don't think we could say for sure until we make new highs. We had a really sharp correction, a 21% peak to trough correction, and the rebound has been incredibly sharp. So you should be able to see that chart now, the S&P 500 daily chart. So right here, might be hard to see, this vertical line is the beginning of the year. So we were actually down, 20% or so almost on the year, and it was like 21% peak to trough. And we have now come all the way back. So here we are right now at 5,900. Seems to be a kind of a digestion level. But there's been some big movers here. I believe back here, this big gap up was a China deal headline. And then yesterday was the headline that we weren't going to have, at least immediately, tariffs on the European Union. I think we postponed a month or so or something like that. And then that was a big gap up. So we're sitting here at 5,900 on the S&P. The all-time high was back here in the beginning of the year on roughly the mid-end of February at 61.47. So we're only about 200 points below that, or about 3 or 4% below that. It won't take much to punch through those highs if we get another 1 or 2 follow-through days here. So it really looks like, and particularly coupled with the fact that our short-term indicators are quite positive, it looks like we're likely to get new highs. And I'd say also we are now slightly positive on the year, even more so if you include reinvested dividends. So it looks like, to answer your question, so far a non-event. What happens next is what really investors need to worry about, right? And we think that there's good reason to continue to be at least intermediate term, real short term bullish here. Now, that doesn't mean using a lot of exposure or certainly not leverage. We are actually pretty below the industry norm in terms of our risk exposure or our equity exposure. We're presently at about as high as we've been in a long time at 45% equities. The typical allocation is more like 60 to 80% equities. And that's because the macro backdrop is so dangerous here. At any point, this can break because a lot of this is smoke and mirrors and QE and funny money and all the rest that we've all been living through all these years, you know? So I believe here we're going to hang out at 5,900, and I know the chart's not up there anymore, but you, if you recall back to that chart, the 50-day is now moving higher. It's crossed over the 200-day. We have the so-called golden cross in place. So don't be ragingly bullish here, but there's a lot of reasons to be really short-term constructive, even though we have a really, really dangerous backdrop. That's what makes this so dangerous for people and difficult to navigate.
Okay. And, as a capital manager, you have to trade the markets you have, not the markets you wish you had. So the fact that you think that new all-time highs are a potential here, have you guys been increasing your equity exposure? Have you made any changes, any material changes recently to your portfolio?
We're about as high as we want to get right now here, Adam, and I do think that's what makes us quite a bit different than others. And we might be criticized if the market has a vertical move higher, and the market may very well have a vertical move higher based on the pressure that we see building in the indicators. But we are up to 45%, and that's about as high as we've been. We were about a week or two ago, we were at 38%. We removed some additional hedges or really kind of the last hedges we had in place in our portfolio, moving that exposure back to 45%. I don't really see us going much higher than that, almost no matter what happens here in the short term. If we make new highs, I don't want to put us completely into a corner here and say that we won't do something, but we might add a few more percent, but we're very unlikely to go much north of 50%. We're not going to certainly ever go anywhere near 100% in this environment because our clients want us to make good, fair returns, but also look at downside risk primarily. Because when the market was down 21% peak to trough, our average account was maybe slightly negative, maybe -1%. A lot of people are relatively flat at that point year to date. So that's what we're trying to do is make above average T-bill returns. We're not trying to match the S&P. And most importantly, we don't want to have a lot of down capture.
Okay. And, I got to say, to some investors, that sounds sort of like a snooze fest until you have those market drawdowns, and then you know your performance you just mentioned there, your relative performance, being flat when the market's down, double digits. All of a sudden, that's incredibly sexy to people, and they just wish they had been better positioned before the downdraft. So, anyways, kudos to you guys for continuing to deliver upon your mandate there. Um, so you mentioned, Mike, that as the market starts to show increasing strength, you start removing some of the hedges that you have on the portfolio because you think, at least in the near term, they're not as likely to be needed. Um, if I heard you correctly, it sounds like you've maybe removed some of the last of those hedges. What would you need to see to start putting hedges back on?
Well, we need to see the market move lower. We need to see our shorter term indicators flip negative. We've got some fast moving indicators, and some of them could be described as simple as derivatives of moving averages, that type of thing. But we'd have to see, more importantly, some major stops being broken, mental stops, so to speak. We've got the recent low. I'm looking over here at my other screen, around 50, maybe 5,600 or so, recent swing low. If we break through 5,600, which is 300 points down from here, that's about what, 6-7% down from here. It would certainly get us to sit up and take notice. And we would certainly pay some of that in terms of negative performance as a deductible. That's just the way it is. Nothing's perfect. But if we saw a break through that level, we would probably take some stops and lighten up the 45% first and go to 40 or 35%. And we might add hedges back, but I think we'd be more likely to just outright take stops here. We're going to put hedges on, I think, if we get a vertical move higher with force, then we will want to start moving up not only stops, but potentially want to put in floors with put options. The nice thing about the put options is you can put a floor in at certain key technical levels and then let the market run. Now, why don't we just put a floor at 5,600 right now, since I said that that's relatively important? It's just because the sum of all of our indicators, plus this recent washout that we just had, tells us that it's less likely we're going to have another immediate washout. Now, could that happen? Absolutely. Nothing in this business is guaranteed, but we're set at a level that we're comfortable taking that risk. So yeah, we're not gonna get more defensive until we see a breakdown through those technical levels. 5,600 or so would also probably bring us back down below the 50-day moving average, and things would start to look a little more grim. But right now, I think we'll probably make a run for the highs. So we'll see.
Okay. And in terms of what to be long here right now, so you mentioned that you've increased your equity exposure in the portfolio. Where are you placing your chips in terms of how you want to ride this long?
Adam, this might be a good opportunity to kind of highlight a little bit of the tools that we use. So I could chime in here and kind of expose some light on that because we do use a systematic process, data-driven process that kind of lets the market tell us where the strength is and where it's not. And there's a lot of different tools in our tool chest, but one of the kind of the broad tools that we use is a concept called relative strength. And relative strength is kind of like a head-to-head matchup between different sectors compared to other sectors, different geographies, different asset classes. And we're looking for systematic trending strength of one asset class compared to another or certain sectors compared to another. And I can kind of share a dashboard of some of our screens that will tell you like where we see the strength, and frankly is in no small part a picture of how we're currently positioned within the kind of 45% equity exposure that we have. So let me just share this. This first screen I'll share with you here is a look at the sector level. So this is at kind of U.S. stock market sector level. And what this is, it's kind of on a weekly basis here, and it ranks on a relative strength basis from left to right, strongest to weakest. And this is again, it's kind of like a not unlike you would rank sports teams in say the March Madness basketball bracket. It's about head-to-head kind of measuring of strength relative to the other teams on the field, so to speak, or the court. And you can see some of the highest ranking sectors here. And this shows the weekly, how this has evolved weekly over time. So you see, for example, we've got communications, financials, industrial, utilities, and tech. Communications and tech are kind of part of a broader, you might call it a technology and communication sector. But those are the areas that have been really strong. Okay, where do we have overweights? We have overweights in financials, industrials, utilities, and technology. And no surprise there. It's what our systematics signaling tells us to be overweight relative to the market. We do have some broad exposure.
What's moving? Yeah.
What's moving, but also what's persistently either outperforming on the upside or hanging in there relatively better on the downside. It's a comparison of who's winning that arm wrestling match, if you will. And there's a system here where it kind of weeds out some of the whipsawing and the noise. We're looking for durable trends that tend to last until they don't. Okay. Look at the other end of the spectrum, the energy sector. Now, there's probably fewer sectors that most fundamentalists would say is a better valuation play right now, given where these stocks are relative to their own historical valuation metrics, but also relative to the broad market. If you look at the energy sector, for example, as a weighting within the broader market, it's at near record lows, if not record lows. Yet the energy sector has been consistently a laggard. These numbers here, I don't want to make too much of them. They're basically tally counts. The higher the number, the more convincing the strength is relative to the others. So the energy sector has been in the doldrums, even despite, and in healthcare as well. Now, there was a brief few-week period to begin this year where the energy sector and the healthcare sector were like strongly outperforming the rest of the market, but that didn't last. It very quickly turned course, and those have been laggard sectors. If we look more at an asset class level, let's look at broad asset classes. And this, I'm going to go to a weekly screen here just to weed out some of the noise. So we've already talked broadly, and there's a whole depth of indicators we look at, breadth and moving averages and momentum. But U.S. stocks have continued to be very strong, but they've lost the degree of their strength relative to, for example, commodities and international equities. So, for example, if you look here, back going late last year when it was, very narrow market, the U.S. stock market was the only show in town. We had these tally counts up in the 300s. And again, I don't want to make too much detail about that other than to kind of point to the relative differences. And you can see those tally counts have consistently eroded. And what's picked up? Commodities, certainly precious metals as being one key component. The commodity space has helped out, but also international equities. We've seen a very somewhat stealth, but actually systematic um, gaining of relative strength in international equities, both developed and emerging economies. And therefore, of the 45% we have in equities, we have about 15%. So what is that? A little, I guess almost a third or about a third in international equities, spread across both developed and emerging economies. So these are some of the tools we use to not try to guess trends, and the fundamental backdrop certainly is important, but these kinds of tools tell us, not so much what, but when to buy or sell things. And nothing is perfect, and we think of everything in terms of probabilities, but these systematic tools can go a long way towards leaning things into the areas of strength that the market is exhibiting at any given point in time.
All right, well, that's super helpful, John. Okay, so equities. Let's talk about bonds for a moment here. So obviously the big story in the markets right now is that bond yields continue to be really stubborn. Um, I haven't checked it this morning, but very recently the 10 years been at like 4.5%. The 30 years been over 5%, cracked over 5%. A lot of discussion about how obviously this is not the direction the administration wants to see things go in. We have all sorts of issues funding our national debt as that 10-year rises. Obviously, corporate America doesn't want that yield to be going up either, especially as more and more companies are having to refinance their debt as the debt in their balance sheets roll over. Um, we've had a lot of debate recently about the future direction of bond yields. Moody's just downgraded the US government's national debt rating, so that's got people concerned. This morning, um, uh, New York Fed the New York Fed president talked about his worries that inflation expectations might become unanchored, and that would keep bond yields high, maybe even continuing to rise from here. We've now seen what's in the uh, big, beautiful bill that just passed the House by a single vote. And there's a lot of future deficit spending in that. And people are beginning to, kind of lose a little bit of confidence in this administration's ability to rein in fiscal spending. And again, that makes bond investors want to get compensated more. So, there's a lot of consternation right now, I guess, about the fact that bond yields are not coming down and could be headed higher from here. So, guys, tie this all together for me here. How close are you guys watching this, and how worried are you guys about the bond yield situation?
Yeah, Adam, we're
Well,
watching.
go ahead, Mike. Yep.
Oh, go ahead. I'll just say a couple things and then hand it over to you, John. We're not that worried about it, Adam. I know that it's a very popular thing to talk about in a negative light, bonds right now. A lot of YouTube people out there are talking about bond vigilantes and the fact that, bond yields have moved higher and they could move higher still. The truth is they could move higher still. 5% on the 30-year yield is not that high, historically speaking. And, nor is where we are right now, roughly 4.5 on the 10-year. They could go higher. I don't think that they're likely to go higher, but there is constructive technical evidence that says they could, particularly on the 30-year chart. A nice clear breakout of the 5% level is pretty bullish on that chart. But it's our position that bonds are oversold. We're basically 30-year into a decline here post QE. The president and Treasury Secretary have made it really one of their primary goals to get those rates down, and it's our bet that they'll be successful, at least temporarily. So our bullish viewpoint on bonds is an oversold bounce. The president and Treasury Secretary will probably be successful, at least short term. We think there's going to be a sell-off in equities that'll create a flight to safety trade. And while we don't want to be in bonds for 10 or 20 years, we do want to be in bonds for 2 years for a trade. So, but that's what makes a market, right? Is a lot of disagreement. So I know John had perhaps a couple things you might want to say.
Hey,
Yeah.
real quick before you chime in, John. So, Mike, are you guys actually going long then bond duration right now?
Yeah, but we've actually reduced it in this decline. We were a year and a half ago or so at 15% exposed. We were pretty convinced then we'd have an oversold bounce, and we were wrong. And we were proven wrong by the technical action. And once we broke on TLT down through about 95 to 97, it was pretty obvious that we were wrong. And we reduced to 7.5%. So we're 7.5%, and there's really not a lot of technical reason to be in this trade, I've got to admit now. But we've reduced to a level where we can sit back and be a little more fundamental. And we always want to be careful with that because if you're just fundamental and you're in a trade, you can be stuck in a trade for a long time. But, we're set at a level that we feel comfortable with. We think we're right. How will we know we're wrong? The problem with a fundamental viewpoint is it's going to be tough. We could go a little bit lower. We could go in bond prices. We could go to 5% on the 10-year. And that thesis from a fundamental point of view would still be correct. So that's where you have to be careful. It's all about your position size, your exposure, and what you can handle psychologically. So,
Okay, so
that's why we're still in it.
you're not increasing your exposure to bond duration, but you're keeping the exposure to bond duration that you have.
Yeah, there's no reason we're not going to increase for here because we're going to need a real technical reason to increase, and we're not seeing any of that here. So, and I admit that we're on this fundamental kind of hold it and wait and see attitude. And as a trader, as a money manager, as an investor, if you're going to make that kind of call and you don't have clear technical exits, then you better have a position size you can sit with, and that's one that we're willing to sit with.
Okay, but just to be super clear, if I heard you correctly, you said that you do think that bonds are oversold right now, so you would expect bond prices to recover here as a trade.
Absolutely. We think they're oversold. If we get further weakness, we might see, we'll be more likely to trim it from here than add. It doesn't make a lot of sense, perhaps, if you're listening to me say that fundamentally, I think we're going to get a big bounce and we're oversold. But we always have to be able to operate within our parameters and never put clients in a situation where they feel too uncomfortable. And we don't ever want to make any big bets on, particularly in cases where we don't have the technical support because there's just no, what are we going to say? Well, if we liked it at this level, we're going to like it even more down here. That in theory is the right thing to do, right? Buy more when you have conviction. But in this type of market, it just doesn't pay. It doesn't pay to do that. So we might trim it a percent or two from here. I don't think we're going to add more to it. I know we're not going to add more to it if prices go even lower. If it strengthens a lot and then breaks out months and years down the road, we might add back some at that point, but we're not going to preemptively do it here on a guess on fundamentals.
Okay, John, you were going to comment?
Yeah, so I just want to reemphasize, one of the reasons. So I'll be very clear. The market and we as a team, frankly, probably see the most wide range of possible outcomes here with the bond market. Unlike, as overvalued as the stock market broadly is, the suite of indicators is resoundingly short-term bullish here. The bond market is much less so. There's plenty of technical damage that the bond market is dealing with. But let's face it, the bond market is hugely driven, probably more so than any market on the planet, by policy. And policy is a big, big unknown by the day. I mean, we are a headline-driven policy environment right now. We cannot discount how important that is. What does and doesn't get passed for a spending bill, a fiscal package in Congress. That's huge. That will have a huge outcome on the bond market. And it's already in large part been priced in our opinion. But it's not just the U.S. bond market, it's global. You look at the globally, yields have been rising globally. So this is not just a U.S. thing. And it's kind of what you would expect. We have just exited a decade plus in recent years of just absolute unprecedented monetary policy where money was printed out of thin air through things like quantitative easing and reset artificially so interest rates to really low levels that weren't market determined, they were money printing determined. And we have no doubt that genie is out of the bottle and never going back in. It's on pause right now. There's not real true QE going on right now, but in a crisis scenario, especially if we do get a runaway in yields, we think that's coming back. That doesn't mean that bonds are a screaming buy right now. So I'll just reemphasize what Mike has already said. We have a very small position. We have maintained a significantly underweight position, even from the position that we reduced from on technical damage to longer term bonds. Our biggest holding for the last several years and continues to be our largest holding is in short-term treasuries, a year or less. More recently, we did add a little bit to the what we call the belly of the curve, 3 to 7 year treasuries, but we've been decidedly underweight and have become more so the long end. Now let's look at a chart of TLT. This is a holding that we have. It's not an investment recommendation for viewers here because you're not our clients. We don't know you, but let's just look at a chart of TLT just for context, so we can talk about what Mike shared there. So this is a long-term chart of TLT. Back in 2020, that hit 180, let's call it, dollars a share. Why is that? Well, 10-year treasury yields were less than 0.5%, right? I mean, if there was ever a bubble in the bond market, we were sitting in it right there. We didn't own any long-term bonds there, and thankfully so. But here's where we are. We've been tracing out, kind of a somewhat of a range here between the low 80s and let's call it 100. Now, granted, there's been a general trend downward over the last several months. These are all, each one of these bars is a monthly chart. Mike referred to if we see some weakness, below say 84, and I'll zoom in a little here just to give this more nuance. We actually had a pretty lengthy discussion about our plan for this in our investment committee meeting last week. And if we see a kind of a confirmed break below the, let's call it the 84-ish level, that sticks for more than a couple days, like this was just a couple days, we'll likely trim that position. Not because the big picture has changed necessarily. It's just that we have to heed the technical signals. Now, on strength, we would probably take some defensive measure, put on some hedges, maybe reduce position if we get a rally. Mike talked about it being oversold. This fuchsia band here is what's called a Bollinger Band. That's 2 standard deviations below the 50-day moving average. So that technically is oversold. If we bounce, which is certainly possible and maybe even likely, to the high 80s, low 90s, that's probably an area where it makes sense to kind of become a little bit more tactically bullish. Whether that means trimming the position, selling some call options, putting some hedges on, we'll call it as it comes, if and when it comes. But we are not, we're not anytime soon calling for a huge rally in bonds that is like this is the trade of the century. No, it's a very tricky market. The bond market is probably the most liquid traded market on the planet, and in some ways the smartest. And to pick a fight with the bond market is historically not a wise thing to do. So we're gonna call it as we see it, but we still remain very significantly underweight long-term bonds.
Okay. I just want to tie for folks that didn't see it. Video that came out a few days before this one on this channel was with Jim Bianco, and Jim is fairly pessimistic about the future of bond yields. Actually thinks that we may be actually in the not too distant future nostalgic for 5% bond yields. So not everybody thinks that way. As you said, John, there's a lot of debate. Sounds even internally there at New Harbor, but I will say of the people that I interview on this channel, the topic that has the single greatest difference, meaning smart people can look at the same data and come to different conclusions, is really sort of on the direction of inflation and the direction of bond yields. So, this is definitely one where, as Mike said earlier, it makes a market. You got people with all different sorts of estimations and predictions of where things are going to go. But thanks for clarifying for you guys how you are managing through this. And we'll get to in a moment here too. I mean, how you guys are managing through a year like this one, where I think, as you said, John, any given day can be totally turned on its head by a policy announcement, which has got to be really frustrating because you can't control for that, right? The way you can for some of these other, trends and risks in the market. Before we get there, though, I think it's just worth talking about, the spirit of bond yields going up, and potentially because that's concerns about continued deficit spending and things like that. I think while people are increasingly worried about the economic impact that higher interest rates might have, I think people are also getting concerned about just purchasing power of fiat currencies of countries that continue to just rampantly deficit spend. And that seems to be, common amongst all major nations that have fiat currencies. Um, so, we've seen gold continue to hang in there quite well. It's gotten, it's been volatile, right? It's had some pretty big downdrafts, but I think at the day we're talking, it's still over 3,300. It's not that far away from its all-time high. Bitcoin has seen a real resurgence in price. I think it's up around 108, 109,000 on the day we're talking here. So, what I know you guys hold gold and some gold miners as a key foundational part of your portfolio. What are your guys' thoughts about, these rising concerns about purchasing power, and, is that giving you even more conviction in the precious metals trade?
Yeah, I mean, we're concerned about purchasing power. Our clients are concerned about purchasing power. I can say it's not a new concern. It's been a concern for quite some time, more than 10 years. We've been in this quantitative easing environment, and for that whole
Right.
time,
But if you have those
inflation's
concerns, they're getting inflamed right now, I think, by the revised, focus on deficits,
well, absolutely.
deficits not getting tamed. Yeah.
Post-COVID, I think that's really when people woke up and took notice. Right? So our clients, they tend to be skeptical about modern financial markets, just like we are, and particularly modern central banking. So, maybe they were early in being concerned, but it seems like the masses, most people really became concerned post-COVID when inflation hit 8 or 9%, post, stimulus checks and deficit spending, $7 trillion spent post-COVID in response. And that caused, I'm sure you probably remember the I bonds, were paying 9% at that time because that was the CPIU during that time. The CPI as calculated by the government. That's now come down to more like 4 or something. So, but people are concerned, central banks are concerned. They've been buying in record amounts for the last bunch of years. And certainly the bond market has spoken. It's up at 3,300, like you said today. And it's been in this range of 32 to 3,400 for a while. We think when it breaks out of here, the next range will be 38 to 4. 3,800 to 4,000, that is. Now, the funny thing is that silver really hasn't followed suit yet. Silver looks like it wants to break out of this $35 range. It's sitting right around 33-ish right now. If it breaks through that 35 range, it should go up towards 40 pretty quickly. But so we're still very bullish on bullion. We suggest that people have 5 to 10% of their investable assets in gold and silver bullion, ideally split maybe two-thirds gold, one-third silver, something like that. And so, yeah, we continue to be supportive of that. And we're liking the fact that the mining shares are showing relative strength over the bullion. Finally, after many years, the last few months, the miners have showed relative strength, and that continues to be the case. The biggest opportunity, though, probably in that whole area is silver. If it breaks through that 35 area, it could accelerate from there. So we're keeping a close eye.
All right. And how is silver doing right now? Is it showing signs that it's going to punch through, or is that 33 price level still providing kind of a frustrating resistance?
Yeah, it's kind of frustrating. Give me 1 minute. I'll pull up a chart of a silver ETF, and you'll see every time it wants to kind of break through, it just kind of keeps getting beaten back. And I know some people will say the silver market is controlled or managed. I have no idea really if it is. It doesn't matter because even if it is, it's not going to be able to be managed forever. But here's a daily chart of silver. And just these last days here, like this would be, I guess, Friday and then Wednesday. Look, it tried to break out of the range, tried to break out of the range, and then it's beaten back each time. So try not to look too closely at silver. The bigger picture is it's got several touches at 35. So right here back in October, right here in March of this year, and then I think we're going to see a breakout sometime here, and we're going to touch that area of 35 on spot silver again. Normally, when you touch 3 points, a triple top, so to speak, or a triple bottom, particularly in the commodity land, less so with stocks, I'd say, but in commodities, it seems to not hold historically. So if we can break through this line that I've just roughly drawn on this chart, that's 35 on spot silver, I think that we should break through and accelerate. So that's kind of strange that it's not trading, silver's not trading anywhere near a high when gold is trading near a high. And then also the silver to gold ratio is near 100 to 1, whereas in recent years it's been 60 to 80. So there's a a sure sign that maybe silver is offering an opportunity. Yes, it's more industrial related. Yes, it's more sensitive to economic cycles. Maybe that's what's holding it back. But watch the 35 level. That's really what the viewers need to know. Watch that 35 level. If it breaks through, we should see some kind of bigger move.
Okay, and by bigger move, I think from our previous conversations, we break through 35. You don't see much resistance up until at least sort of the early 40s, right?
40-ish. Yeah, 40-ish, maybe low 40s. And then from there, I'm sure we're going to be talking about silver making a run for the high. So I don't want to make too much of a prediction too far in the future, but that they should run right towards 40-ish, and that's $5, on top of 35. It's a 15% run. Um, and I think that would be more in the shorter term. So there's really some good opportunities. For most people, though, if you're a trader, I would say that you don't have to anticipate that. You could wait for that break. If you don't already own it, I wouldn't wait for the break. I would just buy some here and make sure you've got a position.
Okay. And I do want to again give you your credit, Mike, for the past, gosh, at least year and a half or so, you'd really been watching the cup and handle and gold and the triple top on the handle and telling people you thought gold was going to make a big run. And I think, back then it was like what, 1900, 2000 or so. And of course, gold's had a great run since then. Um,
Yeah, thank
so
you. It's been a hard trade for some people, and we were on the record for recommending it to clients for a long time. So even post 2012, 2013, and all those years were a little bit difficult to keep recommending it, and we certainly didn't look very smart then, but we knew it was the right long-term hold. And here, particularly as we're consolidating in that 2000 level, it was a level that we thought would create an extension, much like we're talking about silver here too. So thank you.
well, and I just recorded with Stephanie Pomboy about an hour before coming on here with you guys, and she made the comment that if you just look at it from I think a past 12 month standpoint, uh, gold's up like 40% and the S&P is up like 11. So its relative performance, at least in the past year, has actually been quite good.
You can go all the way back to 2000 and look at that, Adam, and it's the same story, right?
Yeah.
Believe it or
And
not.
it always,
Yeah,
depends on where you choose your starting point. So
of
I don't want to
course,
get too wrapped in
of
the weeds
course.
on that. But just, recently the narrative's been, hey, if you've been out of stocks, you really
Yeah.
missed the big party. Uh,
Adam, I'd love to piggyback on the goal because I think this is really apropos also in the context of how bonds fit in a portfolio. If you allow me a couple minutes to
sure.
elaborate on that. And it reminds me of a video I just did on our YouTube channel, New Harbor Financial YouTube channel. And the theme of the video was I challenged four kind of quote unquote truths, Wall Street truths that we think investors should question every day because sometimes these dogmatic truths they got enough gems of truth in them that people just accept them blindly, but they oftentimes break down, and especially when you apply it to an individual client and investor situation. But one of the truths is that by and large, our industry invests by risk tolerance questionnaires, and it has some semblance of a questionnaire that asks people what their timeline and their risk tolerance is. In the video, I talk about how I think it's even a flawed question because many people don't understand the difference between risk and volatility, and the very academic models that are used don't they confuse the issue. But generally it prescribes a portfolio that more or less is a mix of stocks and bonds. Maybe some token little sprinkling of some other stuff there, but it's stocks or bonds. And the only question is, what is the mix? We think that's a very, very short-sighted way to invest. And by way of example, let me just share this chart here because it speaks to how this breaks down in practice. This is a chart that looks at the performance of two kind of set it and forget it allocation funds these happen to be offered by iShares. Very low cost ETF based, portfolio in a trade kind of one is what they call the conservative, which is 30% stocks, 70% bonds. And the other one's the aggressive, 80% stocks, 20% bonds. And what this chart shows is the drawdown off of the peak for each of these. And what you see here is, and this goes back to the beginning of 2022. Of course, 2022 was a challenging year for both the stock and bond markets. But what you notice here is that the so-called aggressive fund wasn't that much worse off than the conservative. In fact, if you look out here in by fall of 2023, the drawdown on the conservative fund was every bit as bad and nearly as bad, even in the worst of it, as the aggressive fund. And what's worse is because the bond market has been so challenged, the aggressive fund has actually been a quote unquote less risky investment than the conservative one. And yet we have legions of folks investing blindly based upon a risk questionnaire and a set it forget it thing in their 401k plans or whatnot that just sometimes misses the whole point about how you define risk and what it means for the safety of one's assets. And then more broadly, this whole idea that, there's this free thing called diversification. And so long as you have the proper mix of stocks and bonds, you're going to do just fine. Well, that misses the point that in sometimes that actually fails miserably. The 1970s, for example, both stocks and bonds lost money on an inflation adjusted basis. There was no hiding. You needed to be in things like commodities. This chart is a long-term simulation, if you will, that Bank of America put together. And it hypothetically showed if you had replaced the quote unquote 40% of a 60-40 portfolio traditionally held in treasuries with commodities, you would actually have outperformed over this long period of time, especially in periods like the 70s here, we see this gap opening here and more recently here with the weakness in bonds. All to say is that as much as we can talk about the health or the prudency of investing in the bond market, we should just as, in fact, if not more importantly, be talking about making sure folks have proper, not just token, but proper meaningful diversification into the real things, literally real assets, commodities, precious metals, especially if we're in the kind of environment where fiscal concerns are ruling today. There's a reason global central banks have consistently and have projected further that they will continue to do so, have diversified out of U.S. dollar reserves and treasury reserves in favor of things like gold and precious metals.
Okay. Uh, very well said. Important point. Do me a favor, just bring up the that last chart you showed there for a second again, John,
Sure thing.
where folks had 40% in commodities versus bonds. I just want to note that this is a logarithmic scale
Yes.
on the y-axis there. So the further you go towards the right, that gap is actually much wider on an absolute basis, right?
Mm-hmm.
So even though the gap in the 70s looks bigger than the gap we see now, the gap we see now is actually probably bigger by at least an order of magnitude.
That's exactly correct, Adam. Thank you for pointing that out.
Yeah, no worries. Just want to, underscore the power of what you're showing there. All right, guys. Well, look, as we begin to sort of wind down here, I mentioned earlier that it's got to be really tough to be navigating capital like this in a market like this. In other words, you can look at your technical analysis, you can have your fundamental assumptions. You can start the day saying we feel really good about, when we take in the totality of the data, how we're positioned. But then a new headline comes in and says something like 50% tariffs on Europe, or whatever, right? Where you have to, first say, look, what probability do we assign to this? But okay, if it is going to happen, we got to do the math, and what impacts is that going to have on the economy and on stock prices and all that stuff. So, can you speak to what it's like to invest in this kind of highly volatile and just a highly chaotic type of environment?
The best way to manage with a chaotic, to manage or to survive a chaotic environment, Adam, is to slow down the speed, reduce your velocity. And in the investment world, that means reduce your exposure. That's really it. We've made a conscious decision to be underexposed here. I mean, in a lot of the modern era here in the last couple of years, even we have had an insanely overvalued market, and we've been underweighted. And the individual investor has the same exact opportunity. If you're 100% exposed, or even worse, you're using futures, you're on leverage, you're going to feel like you're going 200 miles an hour. You're not going to be able to survive it. The first curve, you're going to hit a bump and have an accident or something. So, this market is not one to play around with. If we were to use an analogy like a tightrope analogy, you're walking on a tightrope between, two canyon edges, 3,000 feet above the ground. Versus with better valuation numbers, you're 2 feet above the ground. So you really can't have a lot of exposure. Reduce your speed, your velocity. That's what I keep telling myself. That's what I say to clients. That's what we say to clients. And it's okay if you underperform a little bit in an up market. What you have to do is look at a full market cycle. We still think we're going to get, and our clients are going to get a fantastic opportunity. All the time we're talking to people, even people that aren't our clients, and they're saying, geez, I'm in all T-bills. I'm in the T-bill and chill. What should I do? I'm in that trade. Well, if you've been in that trade and you're still in that trade, you really can't go that wrong by staying in it and waiting for the drop. Now, you might argue and say that we're wrong. We're never going to get a drop. We're never going to see a big, a big correction. But history tells us differently. It's coming, and it's certainly been longer than I think it should have been, but it's coming, and you'll get great opportunities. So that's what we how we manage that's what we're seeing. But managing psychology is a big part of what we're doing. For instance, in bonds, a lot of people are concerned about bonds, and the media is talking negatively about bonds, and a lot of clients are asking questions. And I wouldn't bet big money on this, but that's often a contrarian indicator. We're seeing a little bit of mini capitulation across the board in a lot of things that we look at. So, but again, you reduce velocity, stay in the trade if that's what you're trying to do. So just slow down. And if that doesn't help, and or if that advice doesn't help, reach out to us. We're happy to talk you through this. We understand the markets, we understand psychology and how it interplays with the markets, and we're happy to help you. But just really reduce the exposure. Now is not the time for the big swings. We think there's a time coming, and probably within the next year or so, maybe a year, year and a half on the long end, that would be a better time for the big swings. But now is not one of those times.
And
That's a great point, Mike.
Yeah, Adam, I'll just
I'll let
add,
you.
yeah, sure, go ahead.
So just on that point, uh, Warren Buffett has said this. He tells an anecdote about Ted Williams, and Ted Williams was a real student of baseball and had this approach called the science of hitting, and he had mapped out his strike zone, and he knew his probability of his likelihood to hit, a home run wherever the ball was pitched in the strike zone. And, Ted knew where his sweet spot was, right? And Ted basically said, look, my job is just to not swing until the ball is in one of my sweet spots, right? And that makes a lot of sense. Now, Warren Buffett said that Ted Williams's problem is that he only had so many strikes, right? So in other words, he couldn't control the pitches that the pitcher was pitching to him. So of the balls that were in the strike zone, they all might not be in his preferred area, but if it's going to be a strike, he's got to swing, right? So Ted Williams had to swing at a bunch of pitches that weren't his absolute perfect pitch. Warren Buffett has said, as an investor, I'm like Ted Williams, except I have an infinite number of opportunities. I can sit on my hands for years if I need to. I'm only going to swing when it's right in my absolute sweetest spot. So, Mike, you're basically saying this is not a time right now where the market's delivering you lots of fat pitches. So just wait. There's no pressure to have to make swings now. Am I summarizing that
I
correctly?
think so, particularly now that there's an alternative. T-bills are paying 4.1, 4.2. A few years ago, that wasn't the case, right? You were forced to do something or accept zero. Ted Williams was before his time. If you go online and watch a Major League Baseball game in progress, you can click on, Gamecast, I think it is, or something like that, and you can see the grid on the strike zone, which will tell you that batter's percentage for each of those positions. Now, the real skill, of course, is not only being able to swing the bat and hit the ball, but you've got to be able to make that judgment in a split second with the ball coming at you 100 miles an hour. So I don't envy those guys.
Yeah. And again, as an investor, you don't have that pressure. You can take the time to really do the math and think. All right. Sorry, John, you had a point you
No,
wanted to
no,
make.
because that's actually a fabulous analogy for what I was going to say. Not only do most investors not have the pressure that they think they have, the best way to understand that is kind of going through the process of bringing it back to your own situation. Many folks have built themselves a very nice, stable situation that, as long as you don't screw it up by swinging at balls that they don't need to swing at, they're going to be just fine. And that's where the financial planning work we do comes into play. We've done, just recently a bunch of those and updates to financial plans to help people kind of understand that, hey, I am okay. I don't have to feel like I got to be in it at all times. And that's another, kind of myth that I kind of debunked in that video I spoke of on our channel. Like this whole, you know, Wall Street and the financial industry does folks no promise, no favors when they throw out these stats like, well, if you missed the 10 best days in the market, you've irreparably blew up your possibility of doing good for yourself, which is just, I'm sorry, BS. In fact, I show you, well, if you missed the 10 best days, but also missed the 10 worst days, you're better off. And guess what? If you missed the 20 best and the 20 worst days, you're even better off. So in other words, you can set out a whole lot of pitches and still actually quite do better, even better for yourself, depending on your situation and where you are in your own life cycle. So it's really important to bring it back to your own situation.
Okay, and I think a key part of bringing it back to your own situation is having a really good sense of what your goals are, right? You don't necessarily need to beat the market year in and year out if you're close to your goals, right? You might be able to take a lot less risk and still safely hit your goals, right? So you want to make sure that you're right sizing the risk you're taking and that you've got a really good sense of the cost of the downside, as you guys like to
Absolutely.
say a lot in your business, John, right? A lot of your clients, because wealth is generally correlated with age, a lot of your clients, their kids are out of the house, they're thinking about retirement, maybe they're in retirement, and they don't necessarily have the time to recoup a costly mistake, right? If you're taking on more risk than you should, you get caught in the downside of it, maybe takes the market 5, 10 plus years to get you back to even. A lot of these people don't have the luxury of waiting that long, correct?
Absolutely. And especially when you're in a retirement period or near retirement, when you actually need to draw on your funds, the sequence of returns really matters a lot. In other words, if you happen to suffer a loss or a large loss early on in your years of retirement, it could be absolutely devastating to the ability of your nest egg to fund your living expenses for as long as you should live. You take that same sequence of returns and reverse them so that the bad years happen later on in life, no problem, right? It's a completely different situation. And I think one of the big misgivings of our industry is this idea that it's this, random coin flip as to when the markets are going to have their challenging periods. We know with the benefit of hindsight that tough times are born from rich valuations and very extreme markets, which we've checked those boxes for years now. Doesn't mean it happens right away, but that's when the real problems happen. And the probability is not an equal coin. There are times where the probability of nasty outcomes are much greater, objectively speaking, than at other times. And it's really important to understand that in the context of a market cycle.
All right, so we got to wrap it up here for time's sake, guys. But my job here is to always try to help the audience see themselves in the discussion. The so what, why is this important to me? In a time like this, where I think emotions are more inflamed than normal. Perhaps doubts are higher than normal in this market. And oh my God, we're getting whipsawed every day. The markets had a massive drop. Now they've come back. I had FOMO, then I had total despair. Now I think I'm getting FOMO again. But geez, I have no idea what's going to happen with tariffs. And the person who is just feeling completely spun around and emotionally exhausted right now, if they were to call an advisor like you and just say, "Hey, help me out," can you just take a minute and just walk through kind of what you would do to help that person feel like they're getting their head, you know, screwed on better?
Just talk to them, Adam. Really, there's a bunch of questions we'd probably fire out pretty quickly if they didn't just open with a discourse. But generally speaking, we want to know what keeps them up at night. What are they worried about? What are their goals? What are their risk exposures? What does the family look like? I had a conversation yesterday with a man that was 20 or 25 years older than his wife, and he wanted to essentially make sure she was okay. And he was actually, for the most part, self-managed, but he was worried what happens if something happens to her. I helped him brainstorm some things like investing in passive real estate, buying a pension, i.e., immediate annuities, just passively putting together a bond ladder, that type of thing. So it's really all about finding out what they're concerned about, what really makes them nervous. Other people might just be too exposed and they don't feel good about that. Other people might be all in treasury bills and they know that that's okay right now, but they don't know what the heck to do next, right? So those are the kind of conversations that we have. And so to really help them feel better, Psychologically, we have to know what's making them unwell psychologically, so because most people we encounter have some amount of money. And if you have some amount of money, it's a huge difference from having none. And all of the experience that I've had in this business, I found that if you have no money whatsoever, you're constantly under pressure. You're constantly anxious about it. But if you have something, and that something isn't as big as you think it is, you read all these articles out there that say you need 3 million, 5 million, whatever. I can tell you a lot of people don't have that. If you have 300,000, 500,000, something like that, I can tell you that's a huge difference because let's say 500,000 might spin off 25,000 a year at 5% return, and there's another 2,000 a month in income on top of Social Security and maybe other income sources. So it's really about getting at those fears, establishing a budget for what that person needs to live on, because it's all about income, not about assets. Fears stem out of not having enough income, right? And so we need to find out what's fueling that fear and find a way to arrange things so that they don't have it anymore. It's a big part of what we do, and we're happy to do it for anybody that wants to talk with us.
So two things you mentioned there that I think are really interesting. One is I'm really glad to hear that that gentleman called you um, to say, "Hey, look, I've been carrying the torch. I've been doing all the heavy lifting, and I'm comfortable doing that. But if and when I die, if something happens to me unexpectedly, I want to make sure the people I care about, that there's already a plan that's in place, right?" And folks hear me talk about this a lot in this channel, so I won't get up on that soapbox fully here. But I'm glad to hear that people are doing it. It's such a kindness to the people you care about. It doesn't really require, an awful lot of work, but it makes a tremendous difference than the alternative, right? Which is that you're gone suddenly, and these people don't have the expertise, the experience, and just feel totally overwhelmed, right? Secondly, for one reason or another, I've found myself spending time recently with more seniors, and I'm thinking about this event I attended over this past weekend, and I'm definitely detecting a greater sense of fear amongst this crowd. Um, these are people who, have assets. I wouldn't necessarily call them the most financially minded people. I mean, they're in their later years. They're just focused on enjoying their retirement and their time with their grandkids and stuff like that. But there's this sense of like, I feel a lot more nervous about the markets now. I mean, one, because we went through this gut-wrenching drop and now it's come back, but they're still a little shocked from that. But they're also just worried about the things that I mentioned earlier, just the constant change, the constant uncertainty. Headlines are talking about higher risk of recession. People are thinking tariffs might be inflationary. People are wondering what tomorrow's headline is going to be. Um, and I think it's kind of beginning to dawn on them of like, wow, maybe I'm not going to have as much as I thought, or maybe I can't rely on my wealth as much as I thought I was going to be able to when I first retired. And I can see that concern, that rising fear, it's generating emotion to them that I imagine for some is then generating fear-driven decision making, which we all know is like toxic when it comes to your wealth. So John, you've been nodding as I'm saying this, but anything to say about that before we just wrap things up?
Yeah, so we'd be the first to say that kind of acting from a place of fear is usually not the right thing to do. But that's not to say that sometimes fears are not justified. And one of the things that we've learned in our work, obviously, we try to be tacticians and kind of experts or near like as much as we can be. It's hard to be a true expert. We're as flawed as anybody in terms of we never get things exactly right. But a really important part of our job is being able to understand and listen to people, right? One of the things that we have found is that the clients that come to us, they oftentimes feel like they're not being heard by an industry that has its own agenda, that has its own, hey, if you deviate off of our prescription, you're doomed to fail, right? So it's an industry that isn't very good at listening to people, right? And from listening, we can truly understand where the fears are coming from and help them work through those fears. Whether it's with data that can help illuminate that, hey, those fears are understandable, but maybe a little bit overblown. But the point is, it starts with, no one likes to be told that what they feel doesn't matter, right? And it getting a little wishy-washy here. But that's a key thing that we've learned is, being able to listen to people, understand where their true fears are coming from, because sometimes they just want to vent it and be able to share it and know that someone is on their team, truly on their team, understanding them and helping them think rationally about the let's face it, it is a very uncertain world, a very uncertain market, that is for sure. And they want to feel comforted that they're not crazy, that some of their fears are understandable and validated, even if our job is to coach them to have more resolve than they otherwise may want to have on their own.
All right. Well, guys, look, I thank you so much for going on the journey with me from, the hard economic stats and market data to this more softer side of things, because I do like to try to make these discussions as practical as possible for people. And I think if we just talk about the market data and we don't really get into the emotions and the personal situations that our viewers are in, I think we miss a big opportunity, to really help a lot of people. So thank you guys for doing that for me. Folks, if you've enjoyed this monthly check-in and deep dive with the New Harbor team and would like to continue to see more of these going forward in the future, please let us know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon as well. Let John and Mike know your feedback as well in the comment section below. And then most importantly, if you'd like some assistance in navigating your own personal financial wealth through these tumultuous times, if you don't already have a good financial advisor who is, meeting with you to come up and develop a personalized, bespoke, and very appropriate investing strategy for you, and then helping you execute it, then feel free to schedule a free consultation with one of the financial advisors endorsed by Thoughtful Money, perhaps even John and Mike and their team there at New Harbor. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill it out. These consultations are totally free. There's no commitment to work with these firms. It's just a service they offer to help as many people as possible. John and Mike, boys, another great monthly recap. I look forward to seeing you next week on our usual schedule to let us know what the market's been up to in the interim. But again, guys, I really appreciate you doing these monthly deep dives.
We had a great time, Adam. We really appreciate it too. And we will see you soon. Thanks again for the opportunity.
Thank you, Adam. Thank you to you, and certainly most to your viewers. We appreciate the opportunity to share a little bit of what we see, and hopefully some value was found in what we had to say today.
All right. And everybody else, thanks so much for watching.
Pretty obvious that you're going to have a Fed coin. I think it's going to go to do to gold. It's going to drive the price really, really high. And gold's going to be one of these things. There's a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point.
Gold prices might rise rapidly to $5,000 or $10,000 if the United States eventually introduces a Fed coin, a closed-loop digital currency system. However, because the gold is not part of the official system, selling it could result in high excise taxes. Some analysis points to silver breaking its decade-long resistance, and possibly moving to higher levels $50 or more if certain large investor flows occur. Tucker points out that long-term holders may still profit when prices rise beyond $50 and probably higher. Stablecoins are now subject to more stringent regulations, including backing, audits, and supervision, after the Genius Act was passed in the United States in July 2025. This increases their credibility as competitors in the digital payments system and may lead to a wider acceptance of digital currency systems modeled after central banks. Known for his opinions on gold, silver, and the future of money, E.B. Tucker is a Resource Company board member, author, and investor. He points out that a Fed coin, a digital currency based on a closed-loop blockchain and under central control, is ushering in a period of more stringent monetary regulation. Major asset manager Amundi has warned that, given its increasing use, stablecoin regulation may disrupt international payment flows and monetary sovereignty. Gold may rise to $5,000 or even $10,000 under such a regime as people race to buy it for protection, but because it is not part of the digital system, selling it could result in high taxes. As a sign of regulatory reform, Fed Governor Michelle Bowman has called on authorities to be less wary of new technologies and more proactive in regulating blockchain and cryptocurrency. E.B. Tucker believes this shift would make gold valuable but hard to trade. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
We're walking into this system where there's going to be increasing control. And right now you have a chance to play these hope things that are going on. And you should do that while understanding that you're pretty doomed. Well, what does that mean? All right, well, you look at this, all this metal here. I mean, gold has done even better, right? I mean, like at some point I just switched to buying only gold because you would need like an armored warehouse to keep all the silver in. But these are things that are going to run, and then at some point they're going to be untradeable. And the gold prices, call it like 25 trillion right now. That's if you take all the gold in the world and you put a price on it. That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Protect themselves from what? Well, it's pretty obvious that you're going to have a Fed coin. I wrote the term Fed coin in 2000, I think 15 or something. It was way too early. Okay, that's the other problem with writing books and reports. It's a huge mistake because people, it's nonfiction writing. You should really write fiction if you want to be a writer. It's much easier to hide behind that. But I put the term Fed coin out because there'll be a closed loop blockchain. And what's going to happen is there'll be no counterfeiting, there'll be no tax evasion, and there'll be nowhere to hide if you run afoul of the monetary regime. And what's that going to do to gold? Well, I don't know, but I'll tell you what I think it's going to do to gold is going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? You might end up in a scenario where if you try to sell that gold, there's this massive excise tax, meaning the gold is sort of like outside of this blockchain system that we're in. Now, to be really clear, blockchain doesn't mean Bitcoin. Blockchain means that the Fed or some new version of the Fed would because you're going to expose the Fed for what it is and have a new, much worse Fed someday. And this would be like a closed loop blockchain. So what's interesting about Bitcoin is you have this like distributed ledger. So you would just have like one ledger, with FedCoin, and it would be like centrally controlled Watson computer that would monitor every single serial number on every single Fed coin as it moved around. It'd be infinitely controllable. And then if you tried to sell the gold, you would be bringing it back into the Fed coin system, which would expose you to whatever tax rate you want. I mean, there might be like this, okay, you could sell the gold for this period at a fixed price, bring it back into the system. Does this sound familiar? Do you remember when this happened in the 1930s? Is there some eerie similarities, like a sort of like a modern day computerized FDR scenario? Okay. Yeah. And so I think when people start seeing this, they start seeing, wow, I mean, this is possible. Now, here's what blows my mind is that then they say, how can I profit from this? And I'm thinking, these capitalists, man, Lenin had it right. These capitalists will be like, they're going to hang me. Is there a way I can make some money off the rope? Do you get what I'm saying? It's like, first step is you just need to see things you just need to see the bigger picture. I mean, you don't have to go profiting from every sort of thing that's going to happen. But
E.B. Tucker emphasizes that the demand for FedCoin would be a response to attempts by individuals to conceal riches outside of the system, particularly in gold, rather than a result of an automatic tax deadline. Authorities may then impose severe penalties after providing a brief opportunity to legalize assets, much like FDR's gold policy but in digital form. This illustrates a larger reality. Society is fixated on money and frequently pursues it unbalancedly. The lesson is to embrace change as it comes, see the system as a game, and concentrate on living life to the fullest rather than fighting against it. Although silver trails behind gold, Tucker points out that long-term holders may still profit when prices rise beyond $40 and probably higher. Let's review the interview.
I think it's not preordained. I think the issue would happen as a reaction to people trying to avoid cooperating with FedCoin. That's what would trigger it. So it's not like they say, on this date, we're going to have this excise tax. I think if people begin hiding, trying to preserve and hide and operate outside of the FedCoin regime, then that's when you would say, okay, we have a window of opportunity for you to get legal with your gold. And if you don't get legal with your gold, you're going to be subject to like a 90% excise tax.
Yeah.
And also like all these, different ways that you can be punished because you're naughty school children, with having your gold. We told you that's only for governments. It's only for, foreign governments, not you. Okay. So that's the type of messaging. Just see the messaging. Like I remember as a kid when we learned about algebra, I was like, what's the point of algebra? And, my father was really smart. He was like, you got to learn how the equation works. And then you're going to see that lots of parts of life are the same equation. You'd be able to solve things in life. I didn't really know what that meant, but it turns out, he was right. So like you see that you kind of see this process. Like what's the equation of FDR? It's easy when you go back and look because everybody, that was around then as an adult is dead now. Maybe there's some people that are old that were kids then, but see the equation and forget about the emotion. And then you look at the modern scenario, the digital version of that, and you say, wow, okay, I see how people hiding in gold would make it harder for a Fed coin to take effect and be a control mechanism. It's going to control your whole life, okay? So everybody in the US is obsessed with money. And they're obsessed with money, and they hoard money. If you notice, people, they don't have enough money. Even people that have a lot of money, they don't quite have enough. Like the Morgan Stanley guy that I use is like, you should not stop working. Because the Tucker letter is like something I do because I love it, right? So like that guy says you should be working more. Why should I be working? Well, you could have more money. Well, what would I do with more money? Eventually I'd do something I enjoy. It doesn't make any sense. People's thinking is broken. And so you have a society that's totally obsessed with profit. I'm not going to say it's greedy because I don't think greed is bad. I also don't think money is bad. It's just that people are out of balance and they do something compulsively. And so when you back up a little bit and you see that this is where things are headed, then your job becomes different. Your job becomes to live now, to keep playing the game, but to know that it's a game and to see where it's going and to not be afraid of that because there's no stopping where it's going. And the world definitely keeps going. And you can survive and thrive through change. 1935 is not when the world stopped. It got infinitely more exciting, and it's going to get more exciting from here. You got to go along with it. You got to flow with it, but you can have more fun when you see what's going on. And so I slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point. Yeah. But silver is lagging way behind, and the silver people talk about it in this way that I don't understand. It's kind of like, when someone's getting like really excited in a different language or something. I don't know what they like about it because we're in this market where you have things like vault higher in price. And I'm like, here to $50 is like 20%. I mean, here to $100, it's like barely more than a double. And like, you can't even find all the stuff. I mean, it's like, I've got so many backyards to go dig around in. I don't know where all this stuff is, but it is fun to go out and find your stash because, I've been buying this stuff for ages. I mean, I just bought it because I think it was cool. That's what people don't understand. Most of the time, you buy something because it's going to go up, it goes down. You buy something because you think it's super interesting and it goes up, and I just think that to me, I'm at a place in life where I'm like, everybody, I'm just watching what you say and what you do, and then I'm making decisions based on what I see. And it seems to me like really easy to make money.
He contends that the true difficulty lies in adjusting to a future with more stringent financial regulations without losing sight of how to survive and prosper in it. Could the launch of FedCoin hasten the devaluation of the dollar as countries look for alternatives? Will silver continue to be a secondary hedge, or will it finally catch up to the momentum of gold? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Gold's up, what, almost 40%,
Yeah.
but gold stocks have more than doubled. So, and so people have made a lot more money, starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. We're going to get into a stage, maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying. If silver hits 50 when gold's at 4,000, and I think that once silver gets above 50, I think it's going to take off. I think the move from 50 to 100 will be relatively quick.
Gold has climbed nearly 40%, but gold mining stocks have more than doubled since April. The bank raised its 2026 gold price forecast from $3,700 to $4,000, citing strong central bank demand, possible U.S. dollar weakness, and expectations that the Federal Reserve will ease rates. If gold pushes above $4,000 or even $5,000 next year, miners could double again, eventually attracting big institutional investors. On the silver side, once it breaks $50, in the near to medium term, especially if industrial demand and investment flows remain strong, the run to $100 could happen much faster. Peter Schiff is a well-known economist, investor, and outspoken critic of U.S. monetary policy. He recalls that earlier this year, gold mining stocks were so undervalued compared to gold itself that they offered far better upside with minimal downside risk. Goldman Sachs sees gold $4,000 if investors shift more into metal. Their baseline is $3,700 in 2025, $4,000 mid-2026. If there's a big dollar asset exit, gold might go toward $5,000. Jeffries says gold mining stocks have underperformed despite gold's big gains. Many miner valuations still reflect much lower presumed gold prices. Newmont has already doubled this year but still seen as undervalued compared to what gold's price implies. Free cash flow growth, share buybacks, etc., are driving analyst upgrades. Peter believes central banks continue buying aggressively to shed dollars, making gold an increasingly vital reserve asset. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
$3,000 an ounce for gold when I can buy gold in the ground that's still valued at less than $2,000. In fact, way less than that. I thought that if you looked at what you were paying to buy these gold mining companies, that gold still in the ground had never been so cheap relative to gold above ground. So it wasn't that I didn't think gold was going to keep going up. Mm-hmm. I just thought, why buy it when they're giving away these gold mining stocks and they're so cheap, and the downside I thought was so minimal? It made a lot of sense. And, now I think year to date, gold's up, almost 40%, but gold stocks have more than doubled. So, and so people have made a lot more money, starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2, and the whole doubling was basically in the last maybe 6 months. Didn't even take a whole year to double. And so, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. So, I'm not telling people to stop buying physical gold and silver now, because it's not that obvious, but at that moment in time, to me, these mining stocks were so ridiculously cheap that I couldn't see putting any money into physical gold when you could just buy these miners. I just did not see the downside risk, and I thought there was huge upside potential. Now we've realized some of that upside potential, but I think in the scheme of things, these stocks are still very cheap. If you look at the PEs of the big gold companies, they're very low compared to historic averages, compared to the market multiples. The investors are not in. I mean, they still had net liquidations all year out of GDX and GDXJ, these gold mining ETFs. Nobody talks about these stocks. Nobody owns these stocks.
Yeah.
Newmont Mining is the best performing stock in the S&P 500, yet it's probably the stock that's least owned in the S&P 500. They're going to make nothing but money for years to come. They are producing a product that everybody needs, whether they realize it or not. I mean, the central banks are huge committed buyers, right? They're not going to stop buying gold because they're not going to stop divesting of dollars. And they keep earning dollars, right? Because we're hemorrhaging dollars due to our trade deficit. So not only do they have to get rid of the dollars they own, they have to get rid of the dollars that they keep getting. And so they're going to keep buying gold. And as the price of gold rises, it's just going to suck more central banks into it, because the central banks that aren't buying gold are falling behind the ones that are. And gold is becoming increasingly more important as a reserve asset, not just because central banks are buying more of it, but because the price of what they own keeps going up. And that means that the value of their gold as a percentage of total reserves keeps going up. And so, there's going to be a FOMO in central banks to get into gold. And they're just, they're price agnostic. I mean, they're not going to stop buying because the price goes up, because they're just trying to get rid of their dollars before the price goes down. But at some point, the investing public is going to join this party. I mean, I think to an extent, some money is already coming in, and that's why the gold stocks have had the move that they had. But this is just the tip of a huge iceberg that we've seen. And so far, the buyers have been patient, and they've been buying on the pullbacks, and there hasn't been any crazy up days. There's no real euphoria, and I still see sharp corrections like what we're having today. Gold doesn't even go down, right?
Yeah.
And all of a sudden these stocks are down 3 or 4% just because people are afraid. Oh no, this is it. But the minute gold doesn't go down and goes back up, then the buyers come rushing in. The coast is clear. But we're going to get into a stage maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying.
Peter highlights that smaller gold companies with proven reserves but no production yet offer strong value, as larger producers flush with cash may buy them out rather than fund risky exploration. Gold is up 30 to 40% year to date, with miners outperforming but still undervalued, leaving room for further gains, M&A, and institutional inflows if prices hit $4,000 to $5,000. Central banks remain steady buyers, reinforcing long-term demand. Juniors with proven reserves but no output look attractive as takeover targets for cash-rich majors. Silver faces structural deficits from industrial use and ETFs, making it highly sensitive to new demand. $44 to $50 is the next target, with a possible rapid surge to $100 in a blow-off rally. Peter predicts if silver breaks above $50 while gold hits $4,000, it could quickly surge toward $100, unleashing pent-up demand, since silver is still below its 1980 high while gold has far surpassed its own. Let's review the interview.
There's a lot of smaller companies that aren't as speculative as you think. I mean, if you're talking about a pure exploration type company, because you don't know what they're going to find. Maybe they find nothing. But there are a lot of very small companies that have proven reserves that they just haven't raised the capital to dig up yet, right? They're at the earlier stage. You're not at the exploration stage. Although they may be exploring for more, but they have provable assets, and they just haven't developed them. So they're not, in production. They're not generating any income. And I think there's some incredible value there, because I think these companies are going to get bought up. I mean, it'll be a much friendlier environment to raise capital in the future, and they will be able to raise capital to build out these projects. But I don't think they'll have to, because I think the bigger companies that really have not been investing much in exploration and development, they've just been paying down debt, and now they're buying back stock. I think they're just going to have so much cash that they're generating, they're going to have to do stuff with it. And I think it's going to be cheaper to buy out other companies than spend money on exploration and development. I mean, because you roll the dice on exploration, you don't even know what you're going to find.
True.
Why do that when you could just buy up these companies and get their whole book of business, right, on the cheap? So I look, there's just going to be so much money made, I think, in the consolidation of this industry, which I think is going to happen before there's any really major increase in exploration and, of new projects, which is another reason, the price is going to keep going up.
Yeah.
Because there's not going to be, it's not like when gold is $5,000 an ounce, there's suddenly going to be all this extra gold that's being mined. It's not going to be there. Yeah, there may be some more marginal supply. Maybe Americans will start selling off their jewelry at $5,000 gold, to pay the grocery bill, but that's not going to make much of a difference in the scheme of things. And so there's not going to be a lot of new production. Yeah. And, one of the sources of supply used to be central banks selling. Central banks are not selling. Again, they're buying, and they're going to keep buying, especially these emerging market BRIC nations. They still have, very small percentages of total reserves in gold, even though they've been buying. They have a lot more to buy. Yeah. It's just that the major central banks, like, in Western Europe, United States, where we still have a lot of gold, but we haven't been buying, right? The United States hasn't bought any gold. No. I mean, we're thinking about buying Bitcoin. That's how dumb we are. There isn't a lot of silver out there relative to the demand that I see for it in industry, but silver is just cheap, and it's cheap relative to gold. And that's the best barometer of whether something is cheap or not, is look at it priced in gold. And you can still get a lot of silver for an ounce of gold. And, even at $50 silver and $4,000 gold, that's still 80 to 1. Yeah. That's still pretty cheap. Yeah. If silver hits 50 when gold's at 4,000. And I think that once silver gets above 50, I think it's going to take off. I think the move from 50 to 100 will be relatively quick. I mean, it'll be a lot quicker than the move from 30 to 50. It may even be quicker than the move from 40 to 50. But I think it's going to unleash a lot of pent-up demand. I mean, why shouldn't silver be double its 2000 or 1980 high? I mean, gold's 1980 high was 850, and we're quadruple that. So, I mean, and silver is still below its 1980 high. And so, there's not that many things that you could find that are cheaper than they were in 1980. Silver's one of them. I think it's very cheap. And other precious metals are cheap too. Look at platinum. I mean, compared to the price of gold, and platinum has already had a big move this year, but it's still pretty cheap. So I think we're finally starting to see some of the other precious metals moving, but silver has always had a stronger monetary correlation with.
Would central bank purchases result in a permanent floor on the price of gold and silver? Before the next step higher, will institutional investors finally see the benefits of mining stocks? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at 50 bucks, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at 50 bucks, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, "Oh boy, you break through that, and I'm gonna blow the cork off this thing." The spread is about to do that, I think, and when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006, and it wasn't until late 2007 that the stock market finally topped, and it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. And as I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid. It's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.